Hey everyone, welcome back to Corporate Decoder, the place where we unwrap the mysterious language of big business. Today, we're diving into McGraw-Hill's latest financial move, and it is all about paying down debt. So, what is the big deal? McGraw-Hill announced they've paid off a tidy sum from their loan. It might sound like simple accounting, but this kind of move can tell us a lot about a company's health and future plans. Let's decode what this really means for McGraw-Hill. And hey, before we get too deep, if you like getting straight answers from these complex reports, hit that subscribe button. Also, join our Discord community linked in the description below for more real-time insights and discussions. Alright, so this report is from McGraw-Hill Incorporated. They are a pretty well-known name, especially in education and finance. Think textbooks, learning platforms, and financial analysis tools. They've been around for a while and are a big player in their industries. The key date we're looking at here is the 16th of October. 2025. This is when they announced a significant financial event. This is a standard filing with the US Securities and Exchange Commission, or CSE. If a company is publicly traded, it has to report important events to the public. This type of report, an 8K, is for current reports, meaning it is for big news that is a routine update. This tells us about their stock. They have common stock, and it is not worth much per share on paper, which is typical. The ticker symbol for this stock is MH, and it is traded on the New York Stock Exchange. So this is a publicly traded company, and its stock is out there for anyone to buy and sell. This part of the report is about something called Regulation FD, which basically means that important information needs to be shared with everyone at the same time. No secret handshakes or special treatment for certain investors. Companies have to be fair and open. Here is the main event. On the 16th of October 2025, McGraw-Hill Education, which is a part of the bigger McGraw-Hill company, announced they paid off $150 million of a specific loan, called a term loan. Think of a term loan as a big loan that a company takes out for a set period, often for larger investments or operations. Paying off a chunk of this loan is a pretty big deal. This loan has been around for a while, since July 2021, and has seen quite a few changes or amendments over the years. This just shows that their borrowing arrangements are dynamic and have been adjusted multiple times. The fact that they reactively paying down the principal on this loan signals financial strength and a strategic decision to reduce their debt burden. To get more details, they attached a press release as an exhibit. This is pretty standard. They essentially saying, here is the official announcement. Now, why is paying down $150 million in loans significant? Well, for a company like McGraw-Hill, it means they are likely generating enough cash flow to not only cover their day-to-day operations and investments, but also to make substantial payments towards their debts. Reducing debt has several positive implications. First, it lowers the company's interest expenses. Every dollar they pay off the loan principal means they have to pay interest on that dollar in the future. This directly boosts their profitability. Imagine if you borrowed money to buy a house and you suddenly had an extra $150 million. You could pay off a big chunk of your mortgage, saving you a ton of money on interest over the years. For McGraw-Hill, this translates into more money available for other things like research, development, strategic acquisitions, or even returning value to shareholders through dividends or stock buybacks. Second, a lower debt load generally makes a company less risky in the eyes of investors and lenders. If the economy takes a downturn or if the company faces unexpected challenges, having less debt means they have more financial flexibility to weather the storm. They are less likely to run into trouble making loan payments. This improved financial standing can also lead to better credit ratings, making it easier and cheaper for them to borrow money in the future if they need to. Third, it can be a sign of confidence from the company's management. By actively paying down debt, they signaling that they believe the company's future earnings will be strong enough to support further growth, and that they are prioritizing financial stability. It shows they are managing their balance sheet prudently. So, this press release is where the real meat of the announcement is. It details the specific loan and the payment. It is essentially a formal confirmation of the news. This last exhibit is about how the data is presented digitally. It is important for regulators and for systems that automatically process financial information. It allows for easier analysis of the filing in a structured format. Now, let's think about what this means more broadly. McGraw-Hill operates in competitive markets. In education, there is a constant push for new digital learning tools and platforms, battling against other established players and innovative startups. In finance, providing reliable data and insights is crucial, and they re-up against other major data providers. By strengthening their balance sheet through debt reduction, McGraw Hill is positioning itself to be more agile. They can invest more aggressively in new technologies, acquire smaller, innovative companies that complement their offerings, or simply use that freed up cash to enhance their existing products and services. This financial maneuver isn't just about numbers, it is about enabling future growth and maintaining a competitive edge. In essence, this $150 million paydown is a positive sign. It suggests sound financial management and a strategic focus on reducing risk and enhancing future profitability. It is a deliberate step to improve the company's financial health, which is always a good thing for investors and for the long-term stability of the business. It shows they are in control of their finances and are making smart choices to manage their debt effectively. So, what is my take on this? McGraw Hill is clearly taking a responsible approach to managing its finances. Paying down significant debt like this is a strong indicator of financial discipline and a healthy cash flow. It reduces their financial risk, making them more resilient to economic shocks. This move frees up resources that can be reinvested into innovation and growth, which is crucial in the fast-paced education and finance sectors. While there are always external risks like market competition and economic fluctuations, this action strengthens their internal financial foundation. It is a prudent step that signals confidence in their business operations and future prospects. Alright, that is our breakdown of McGraw Hill's latest announcement. What is your take on these numbers and what they signal for the company's future? Do you think this debt reduction will lead to significant growth or other strategic moves? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps the channel grow, and be sure to subscribe for more deep dives into the world of corporate finance. And don't forget to check out the Discord channel linked in the description for more discussions and insights. Thanks for watching, and we'll see you next time on Corporate Decoder.